Ramakrishnan of Franklin India AMC. He's a shy guy, and he believes that equity as an investment, if you are a long-term investor, you should always filter out the noise. I guess that's the reason why he's always lived in Chennai. Anand, fantastic to have you back on ET now. Thank you for joining us. Lot of noise in the market about a revival in animal spirits post the tax cut. What is your view?
There are two kinds of revival we should be looking at in the next few quarters. One is the consumer sentiments revival. As we have seen over the last 3 or 4 quarters, there has been a marked drop in the consumption sentiments, and this is indicative in various numbers, including consumer durables, automobile sales, etc. I think with the credit situation normalizing and the flow of money coming back into the system, we would see some bit of revival in the consumption sentiments. That is primarily the first kind of revival we should be looking at. The other sentiment revival, which with respect to investment sentiments, I think we are in the early stages of fixing the problem. I think government cutting corporate tax cuts should to some extent spur the sentiments towards it, if not the actual numbers. The numbers should follow in due course of time, but directionally I think we are making important steps towards reversing the sentiments in the investment climate.
How would you map the current risk reward ratio? Do you think somewhere markets have run ahead of themselves? Because markets in the short term are a function of sentiment, but economy is a function of mood, animal spirits, and also a cycle. Do you think markets have already started celebrating a new dawn in earnings, or that is something which you would say is actually true in terms of level and positioning?
We can look at it in a few ways. One is on a pure sentiment perspective. Markets have gone through significant correction. If you look beyond the top 20 or 30 stocks, we have seen meaningful loss of value, and that you can say that is a reasonable sentiment correction. From outright optimism, we have moved to an era of skepticism bordering on pessimism, and that is a big change over the last couple of years, and that should change for better with some bit of policy environment, with drop in interest rates, better availability of credit. Many of these sentiment indicators will definitely change for better. But if you look at corporate earnings, it's a different story. Even after the first quarter, we have seen significant correction or moderation in corporate earnings growth. This downward revision trend, which was supposed to stop in fiscal 20 and surprisingly continued in first quarter, and in all probability may be there in second quarter as well. The big driver of corporate earnings recovery is not only the banking sector, which had gone through significant erosion in profits, but also many domestic cyclicals. The sectors which have gone through some bit of demand destruction, it can be in real estate, construction, cement, some cyclical sectors like that. We were expecting a good amount of earnings recovery. I think some of the earnings recovery story is getting pushed back. So fundamentally, I would say still we are few quarters away from decisively saying that we have turned around the corner. But sentiments, yes, with the government at least taking steps to move towards more moderate corporate tax rates, we have at least made a turn. This should be followed up with much more bolder steps in terms of moderate personal taxes to spur consumption and sector specific moves to boost the aggregate demand.
The polarized nature of the market, do you think that's here to stay? It's not about large cap stocks, it's about mega caps, and within mega caps there are 10-15 stocks which are sitting at an all-time high, which are making the markets look good. Do you think we are in more for the same, and you think somewhere investors will continue to pay disproportionate amount of premium for near-term visibility?
So, till there is no broad-based demand recovery and earnings recovery, this phase will continue, and which may not be a very healthy phase, but that is the way it is, market is. The investors will continue to prefer earnings certainty, low volatility despite high valuations. However, with if there is a broader recovery, if more sectors participate in growth, more companies come out of sluggish earnings growth phase, we would see more normalization of this trend. For that, we need to move away from slow economic growth to more moderate economic growth environment, and also much more moderate interest rates, so that the benefits of availability of credit, cheaper credit trickles down to the value in terms of number of companies benefit out of it, and this requires a much more larger momentum. If the current sluggish growth phase continues, we would see investors' preference towards companies that are profitable even during tough conditions, companies that are generating good ROE even under challenging macroeconomic situations. Those kind of companies or stocks only will be preferred, and the more challenged companies, businesses which probably have good businesses but maybe having bad balance sheets, or not able to kind of benefit from the current economic environment despite the best efforts, we would see that this bipolar behavior of the market may last longer. So, a lot depends on how the economic growth progress from the current situation. We have reasons to believe, however, that the growth will get more broad based over the next 4 quarters, and we would see some of the companies which are struggling earlier might slowly come out of that struggled earnings growth phase, and the valuations will get over a period of time normalized. So, clearly I think there is a benefit to remain a little more diversified today than about a year back, but we will have to wait and see how the trends play out.
Why do you think the mass majority of fund managers and strategists and analysts have gone wrong in predicting the earnings recovery? We started the year with the assumption that this year will be a V-shaped recovery for Indian markets, but we are nowhere close to that. And when you say that, we could be staring at a broad-based recovery in last 4 quarters, what is so different this time?
So, I think in our mental models, we look at economy as an engine with 4 legs: consumption, investment, government, and net exports. For last few years, economy has been running on only 2 out of the 4 legs: consumption, to some extent government expenditure, and to some extent corporate investments. But we haven't been having very robust investment to GDP growth in the last few years. But innate in our thinking is that over a period of time, this also will normalize, and therefore the benefits will accrue to corporates that will benefit from the growth in the investment or capital formation in the economy, and therefore we would expect a bit of a earnings recovery. So, that is the broader thinking. The longer it takes for this recovery to take place, the disappointment set in, the earnings revisions, downward revisions come in, and that kind of has that own effect. That's the way the consensus earnings keep getting downgraded. Portfolio managers or investment managers do have slightly more optimistic view of the world. They do think that growth will improve. They do think that more companies will participate in economic growth. And in that sense, no one bets for a very narrow corporate growth. No one is thinking that only few companies are going to make all the money and rest of the corporates are going to struggle. So, it is in that innate behavioral aspect of being more optimistic is what probably leading to this kind of earnings expectations and then a subsequent disappointment.
What is your understanding of the NBFC problem? You think the problem is behind us, or it's a train wreck which will continue to drag consumption and investment and credit down?
The problem is not behind us. I think we are right in the middle of the problem. I think we are yet to meaningfully kind of extricate ourselves from the situation. I think while at some point of time NBFC stepped in to fill in the credit void that was there in the system when the banks stepped back, I think they also kind of overextended in specific sectors, and unfortunately, there is no easy way out. It's a slow grind. The regulatory mechanisms, the resolution mechanisms are taking much longer because of inherently conflicting nature of our system, financial systems. Even under NCLT process, we have a tough time in finding resolutions. So it's not a surprise, therefore, in NBFC, in an NBFC situation, the resolution is taking longer. So if you ask me, we are not yet out of the woods. We have some more way and probably a clearer risk off the table before we can clearly say that NBFCs are out of the woods.
I'll ignore all the headlines in the consumption space. We all know that consumption is going through a slowdown. But how much of a near-term slowdown or cyclical slowdown problem is in the price, in autos, in consumers, in durables? Do you think this headline slowdown is a buying opportunity for a long-term investor like yours?
Yes, I genuinely believe that some part of this is cyclical, it is not structural, and therefore any erosion in value of the businesses because of a near-term slowdown is an opportunity, whether it is in automobiles or consumer durables, even in specific consumer staples, in retailing companies. If you have opportunities, if you have seen some meaningful correction in valuations because of the ongoing turbulence in the consumption growth, one should use that as an opportunity, because the longer term structural drivers are still in place. I mean, as I was coming into this interview, I read that a couple of online companies have recorded record sales on day one of their festival sales. So that it is not as if consumption trends are broken. It is a bit of a sentiment setback. It will over a period of time normalize, and therefore it's a bargain hunting or investing opportunity, if I may say so, in those specific sectors.
Yeah, outsized bet for many years now has been private banks. That has worked well for last 10, 12, 15 years now for your fund and for your house. Will that positioning change? Because like we say that with each cycle there is a different leader. Are you looking at something which could be a pure big market leader in coming years?
Private banks have done very well over the last couple of decades. They are partly structural plays. India was dominated by government-owned banks in terms of market share. We took an initial call that over a period of time, the private sector will slowly chip away a bit of the market share. Apart from participating in the underlying credit growth, they will also grow a little faster because of this relative shift in the market share, and which is playing out, and I think it will play out for the next 5-10 years as well. It's not as if this journey doesn't have hiccups. There are private sector banks which have gone through periods of slowdown or trouble, and some have come out, some have not been able to come out. So even investing in private sector banks is not without its risks. However, there are winners even in that space, and therefore we need to be aware of that just taking a simple call between private and public sector doesn't necessarily particularly solve the problem. If you ask me, is it a structural trend still will continue to play out? I do believe that. I think the drivers for public sector banks to kind of relatively outperform or moderately equal perform the banking sector is still not there. Government is trying to move towards consolidation of this sector. So you have fewer banks, potentially better run banks over a period of time. We are yet to see that in terms of actual numbers or outcomes. So till we see an evidence that government's efforts to create a more vibrant, viable public sector banking situation, we would like to maintain that bias towards private sector banks.
Are you looking at insurance as a very large sectoral multi-year theme? Do you think there is merit in buying both life insurance and general insurance stocks?
We remain positive and constructive on that sector. It is a sector where it's relative under penetration, both on the life as well as on the general insurance side. People have divided opinion on the life side, but we believe that even on the life side, India is relatively under penetrated and therefore offer a reasonable long runway in terms of growth ahead, and therefore calls for a structural investment opportunity. Having said that, if you roll back a couple of years, 1.5 years back, many of these companies made a debut or IPO'd in a market which was extremely optimistic. So the valuations, the IPO valuations and subsequent time valuations remained a bit elevated, and some of them have gone through some bit of time correction and some of them have gone through some value correction as well.